Hello and welcome. Hopefully, we're now live. I'm Clive Phillips. I head the Rural Business and Natural Capital team at Brody's, and I'm your chair today. This is the last session in our Rural Briefing Roadshow, which we've taken around Scotland, and we're delighted that so many have taken the opportunity to attend either in person or online today. When I last looked, we had 130 people signed up for today. This demonstrates that the rural sector is very far from being a tranquil black backwater. It is at the forefront of a new agricultural revolution, perhaps in more ways than one, given recent events. It's key to nature restoration. It has a role to play in climate change mitigation and energy transition. And at the same time, it's a highly desirable place to live and work. These competing demands for land use puts the rural sector under enormous pressure at times, not least in the area of policy, new markets, and new law. What we've tried to do is to pick out four topics which stand out as both developing rapidly and having the potential to have profound impact on our sector. In the last few years, we've seen the emergence of natural capital markets. The value of natural capital is now an essential part of any rural property conversation. Land reform is bringing greater state intervention into the land market, which will undoubtedly make dealing with rural property more complex and less certain. Then in recent weeks, we've had the budget and the potential it may have to turn succession plans on their head and drive fundamental change in ownership and business structures. As ever, challenges create opportunities, and our expert team at Brody's are here to work with you on that. So we have a great lineup of speakers for you. We have Alex Buchan, who's going to speak about land reform and the impact that may have on large land holdings. We have Scott Logan on utilities and how to manage the rollout of utilities across Scotland. Graham Leith is going to speak to us about natural capital and some of the new developments and the new opportunities. And then last and definitely not least, Lee Gould on succession and tax planning, which of course has a new urgency following the budget. So on that note, I will hand across to Alex Buchan, and do please remember your questions in the queue box at the bottom. Thank you.
Thank you, Clive. I'm Alex Buchan, for those of you who don't know me, a partner in the Rural Business and Natural Capital team at Brody's, based in Edinburgh, and specialising in all aspects of rural property, from traditional land uses such as agriculture and sportings through to development and renewables. This afternoon, I'm going to take 10 minutes or so to look at some aspects of the Land Reform Scotland Bill which may have unintended consequences. The bill was introduced to the Scottish Parliament on 14th of March 2024 and is currently at stage one of the parliamentary process, which is when the general principles are considered. Accordingly, various provisions of the bill may change prior to becoming law, and that should, of course, be borne in mind with what I'm about to say. The bill deals with land management, community engagement and right to buy, further reform to agricultural holdings, and expansion of the current regulatory framework. I'm going to consider today aspects of the bill dealing with community right to buy, transfer of large land holdings, and resumption from agricultural tenancies. So first, what is a large land holding? The bill proposes regulations placing community engagement and land management requirements on landowners with single or composite holdings on the mainland in excess of 300 hectares, or holdings in excess of 1,000 hectares where that constitutes more than 25% of an inhabited island. The provisions that are relevant for community right to buy and transfers of land prescribe large land holdings as over 1,000 hectares. So that's what we're looking at today. But as a result of that, large land holding means different things in different contexts, although the definition is based on scale rather than concentration of ownership, save for that 25% island threshold test. This is quite interesting when you consider that there was a lot of discussion about concentration of land ownership and not necessarily scale. The point being that if you own, say, 100 acres but entirely surround a village, that would likely have more impact on the community than if you own 2,000 acres on the nearest hillside. But notwithstanding that, the bill has largely gone for scale rather than concentration of ownership. The hectareage threshold can be met by a single area of land or by a number of geographically connected areas, either in the same ownership or owned through connected parties. For context, it's estimated that some 55% of Scotland's land mass will fall into the 1,000 hectares plus landholding category. So these proposals are not restricted to the largest landowners in the country. Many areas of rural Scotland and those who occupy and manage them will be affected. So the next slide on community right to buy. The bill extends the scope of existing community rights to buy. At present, as many of you will probably know, communities can register a preemptive right to buy whereby land cannot be sold before the community is given the option to purchase that land. The new measures fit in with the community rights to buy, which we have already, using the existing preemptive right to buy mechanism, but just altered for the specific circumstances. These provisions apply to all or part, and that's important, part of a single or composite holding of more than 1,000 hectares. So on that interpretation or that definition, this could apply to half an acre of a larger landholding. The starting point is an absolute prohibition on the transfer of that land, either the whole of it or any part of it. There are exemptions, including land being transferred otherwise than for value. However, any transfer that is made in breach of the provisions will be of no effect. The starting point is that the landowner must give notice to the Scottish ministers of the intention to sell, even if there's no community interest registered. The Scottish ministers then have to publicise the intended sale or transfer and specifically give information to prescribed persons who are not yet known, plus the community council, the local authority, and any national park authority. A community body will then have 30 days to intimate their intention to register an interest in acquiring the land. If they don't, the ministers will clear the landowner to sell the property. If, however, notice of intention to acquire the land is received within the 30-day period, the community body will be given another 40 days in which to make an application to register an interest in the Register of Community Interests in Land. That process is broadly similar to the one that applies to the existing late registration process. So quite a lot of information. What does that all mean? Well, remember, it's a preemptive right, so it's only where a landowner wants to sell that the process is triggered. But it is far-reaching. It's not just the whole holding, it's part of the holding, as I emphasised before. By way of example, where a landowner wants to sell an area of ground that forms part of a large landholding to, say, a residential owner for a car parking space, they will have to go through the pre-notification process. On a practical level, this could have unintended consequences. We routinely deal with boundary issues identified when a homeowner is selling their property and, say, a fence has been erected along the wrong line. This can often be quickly resolved by the landowner granting title to the area in question. However, that type of quick fix is not going to be possible anymore. Also, the whole procedure and attendant publicity may make landowners who are, in principle, quite willing to sell an additional bit of garden ground to someone think again. And also, who's actually going to meet the associated costs in these circumstances? It seems to me quite reasonable for the landowner to look to the purchaser to be expected to do so. So if such transactions are curtailed or made unviable economically due to procedural costs, that would be an unfortunate consequence, ultimately being more prejudicial to the purchaser than the landowner. And also, it's a big move away from the current situation, which requires community bodies to be proactive. The original community right to buy provisions required a community body to register in advance of land being marketed for sale, with limited scope for late applications. The extended right for late applications came in 2015, but now we are taking a step further, where land sales are being proactively brought to the community's attention and they are given every chance to purchase. In summary, it won't be possible to do a private deal anymore if the area forms part of a large landholding, even where a community body has absolutely no interest in the area. The procedure will still need to be complied with. So that's potentially a huge change to the land market as a whole. Now, moving on to transfers of large land holdings on the next slide. Lotting decisions have been widely spoken about in the press. They were first heralded as a public interest test. Now they are the lotting decision. We're again talking about transfers or sales of areas of land over 1,000 hectares or a series of proposed transactions where the total area will exceed 1,000 hectares. Those transactions will be prohibited unless the Scottish ministers have made a so-called lotting decision. Further, transfers of more than 50 hectares where they form part of a large landholding and more than 1,000 hectares is being marketed will not be permitted without obtaining such a lotting decision. So if you're selling land under 50 hectares, lotting decision isn't relevant. Over 50 hectares might be relevant if more than 1,000 hectares of that holding are on the market overall, and over 1,000 hectares definitely within the scope of the requirements. Any transfers or sales that are made in breach of the prohibition and any failure to comply with the lotting decision will render the transfer or sale null and void. So the lotting decision. The Scottish ministers are to make the lotting decision on the application of the owner of the large landholding. They must request a report from the Land and Communities Commissioner, which is a new position created by the bill, and take into account prior to making their decision. That decision will be either that no lotting is required or lotting is required, in which event the lots must be specified. In a lotting decision, the Scottish ministers may order that the land is marketed in separate lots if this would be more likely to the land being used in whole or in part in ways that might make a community more sustainable than would be the case if all of the land were transferred to the same person. I'll come back to that in a moment. So, at the risk of stating the obvious, it is only about lotting and the specific lots have to be stated. The Scottish ministers do not get to say who the lots go to. However, there are provisions to ensure that the lots don't go to connected persons. There's limited exemptions, including transfers not for value, so family gifts will still be possible, sales to croft tenants and transfers on divorce and separation. The Scottish ministers can also dispense with lotting on the grounds of financial hardship. Additionally, there's a number of purported safeguards in place, and compensation is also payable for the loss or expense incurred in complying with the procedure, attributable to a potential transfer being prevented or attributable to a lotting decision that the land may only be transferred in lots. So, looking at this in a sort of practical sense, if I propose to sell 1,000 hectares, I have to apply for a lotting decision. That decision is going to be based on whether lotting would be more likely to lead to the land being used in whole or in part in ways that might make a community more sustainable than would be the case if all of the land were transferred to the same person. I think it's probably fair to say that that is not exactly a scientific formula, and the potential outcome will be fraught with uncertainty for the landowner based on how that's evaluated. Also, how long is this decision going to take, or how long will the required report from the new commissioner take? There's provision for an expedited process in the bill, but it's not clear what it's expedited from. There's a notable absence of timeframes. Then the question arises, who's going to advise the Scottish ministers on what appropriate lots are in terms of access, service media, practical arrangements? How will compensation work as against value for the whole versus value in lots? That's all up for grabs, it seems, in terms of the bill. Finally, just consider that 200 hectares of my land is let to a wind farm operator, and say another 300 hectares is under option for a natural capital scheme. Any lotting is going to cut across these arrangements. How's that going to work? How are developers or option holders going to view that? It's self-evident that there's all sorts of consequences that potentially flow from the overall intention of these provisions. So moving on to the next slide, dealing with agricultural tenancies and resumption. Now, turning briefly to agricultural holdings, the bill proposes a new overriding procedure for resumption of land from 1991 Act secure tenancies, and also introduces a new head of claim for tenants' compensation across all 1991 Act and also modern form fixed duration tenancies. These proposals are significant, and if passed in the current form, will retrospectively alter existing 1991 Act tenancies and the law applicable to fixed duration tenancies. Currently, a lease must contain an express right to resume land from a 1991 Act tenancy. The bill doesn't change that position. At present, a landlord requires to give a tenant not less than 2 months' notice of resumption, and if the lease specifies a longer period, whatever that longer period is. The bill will require written notice of not less than 1 year before the proposed resumption date. This increased notice requirement will be retrospective and will override any shorter notice period in existing leases. Now, the right to resume on relatively short notice, 2 months or longer specified in the lease, has to date provided landlords with a mechanism to have sensible conversations with tenants about giving up areas of land and, importantly, to give landlords comfort that they can obtain possession where, for example, a developer may be exercising an option. This longer statutory notice period removes that flexibility and, in the absence of transitional provisions, could result in landlords being placed in breach of existing option or other development agreements where they require to draw down a lease subsequent to an option, say on 3 months' notice, and they have a tenant that they now have to give a year's notice to, where previously they had a month's buffer because they could give them 2 months' notice. The changes to compensation on resumption also apply to all types of agricultural tenancies, so both 1991 Act secure tenancies and fixed duration tenancies. Currently, a tenant is entitled to statutory compensation for heads of claim such as disturbance and also a rent reduction following exercise of a right of resumption. The bill proposes an additional head of claim which equates to the tenant having a share in the capital value of the land to be resumed. The valuation process is detailed, but the bill expects it to be completed within 10 weeks of the valuer's appointment by the tenant farming commissioner. In broad terms, the valuer must look at the vacant possession value of the land being resumed as against the value subject to the tenancy. The compensation payable to the tenant is to be 50%, 1/2 of the difference. A key point is whether or not such compensation takes account of a future non-agricultural use. If the landlord is resuming for a housing development, say, or a renewable scheme, is that taken into account in the figures? Probably not on the current drafting of the bill, because the valuation methodology states that any use not permitted by the lease is not to be taken into account. And Generally speaking, agricultural leases are fairly prescriptive on the use that the land can be put to under the lease. But I would suggest that clarity is needed on that rather than leaving it to the terms of each lease. Whether or not development value is factored in, the proposed change in procedure for 1991 Act tenancies represents a significant departure from the usual contractual provisions on resumption. And the new head of claim for all types of tenancies is going to be a very material alteration to the landlord's position. If these provisions are passed in their current form, having retrospective effect, landlords and tenants in existing leases and new ones to come are going to have to consider the implications for their arrangements. That brings us to the end of this quick canter through some of the far-reaching and potentially very significant consequences of the proposed legislative reforms. I do hope this has been informative and given you some food for thought. I'll hand over now to my colleague, Scott Logan.
Thank you, Alex, and good afternoon, everyone. So I'm Scott Logan. I'm a partner in the rural business and natural capital team at Brodie's, and I specialise in compulsory purchase and utilities matters. And so I'm going to speak for 10 minutes or so about utilities. Now, given the multi-billion pound investment plan for the electricity networks in Scotland over the coming decade, today I'm going to focus on electricity and the powers available to licence holders under the Electricity Act 1989. Now, these powers are wide-ranging, giving the electricity companies a number of options when it comes to acquiring rights and land. If we could just move on to the next slide, please. So Schedule 3 of the Electricity Act gives powers to electricity licence holders to compulsorily acquire land and also rights in land. Licence holders can use these compulsory purchase powers for any purpose connected with the carrying out of the activities which they're licensed to carry on. So, for example, a power company might use this power to acquire the land required for the construction of a new electricity substation, or indeed it may use compulsory purchase powers to acquire a servitude right of access to get to and from such a substation. Schedule 4 of the Electricity Act then gives further powers to licence holders, including the power to acquire necessary wayleaves, a term that I'm sure many of you will be familiar with. This statutory form of wayleave permits the installation and retention of electric lines and ancillary apparatus, so it is exclusively for electric lines and not for things like substations and the like. The key distinction between a necessary wayleave and a negotiated or voluntary wayleave is that a necessary wayleave runs with the land and binds successors for the period specified in the wayleave. And the standard default period of a necessary wayleave is 40 years, so it's obviously a considerable long period of time. In contrast, a voluntary wayleave will normally fall on change of ownership, so much shorter term in that respect. In most cases, the electricity company will attempt to negotiate a voluntary acquisition in the first place, and as those discussions take place under the shadow of compulsory purchase, most negotiations end up with a deal being struck, even if that is somewhat reluctantly. Clearly, for landowners to be able to assess the strength or otherwise of their position, they need to understand the extent of the company's powers and the likelihood of compulsory purchase powers being sanctioned at the end of the day. So I'll just move on to the next slide dealing with the procedures. A licence holder may formally request the grant of a wayleave from the owner or indeed the occupier of the land, allowing them to install and keep installed an electric line on, under or over the land in question. If the owner or the occupier fails to give the necessary wayleave within the period specified in the notice, now that is usually the minimum statutory 21-day period, so very short period there, then the licence holder then may make an application to the Scottish Ministers for the grant of a necessary wayleave or a compulsory wayleave. Similarly, in relation to existing infrastructure, where, for example, a previous wayleave has expired or has otherwise been terminated, so again, for example, on change of ownership, licence holders have a period of 3 months following receipt of any notice to remove from the land to apply for a necessary way leave, or alternatively to make a compulsory purchase order to keep the electric line in place. And provided they do so within that 3-month period, the line will be protected until the necessary way leave application, or as the case may be, the CPO, is finally determined. Before granting a necessary way leave, the Scottish ministers will afford the owner and any occupier of the land the opportunity to be heard. Now, that can take different forms. It can be at the more formal end, with a public inquiry being held, or a hearing, which is less formal, or indeed it can rest on written submissions, depending on what the party's preference is. Whatever format it takes, it will be considered by a government-appointed reporter that is appointed by the DPEA to look at the merits of the case, and on whose recommendation the ministers will then take a final decision. The reporter will generally consider 2 issues. Firstly, is it necessary or expedient for the electric line to cross the land along the way leave application route in order to meet a specific electricity supply need? And then secondly, what effect will the line have on the use and enjoyment of the land in question? And that second question is really brings in a balancing exercise between the public interest on one hand and the impacts on individuals on the other, making sure the whole process is human rights compliant. Now, it must be recognised that the odds are very much stacked against owners in this process, and that the prospects of resisting an application are not generally high. It would generally be expected that the licence holder will be able to establish the first part of the test, the reporter's satisfaction, and then thereafter it will really take something fairly significant by way of adverse impacts to swing matters back in favour of the owner, particularly given the availability of compensation. Again, if we can just move on. So where a way leave or servitude is entered into voluntarily, any compensation or consideration due will be governed by the terms of that agreement. In the case of a necessary way leave, the entitlement to compensation is governed by paragraph 7 of Schedule 4 of the Act. Where a necessary way leave is granted, the owner or occupier of the land may recover from the licence holder compensation in respect of the grant, and compensation is also available for any damage and disturbance arising from the exercise of the rights granted under the way leave. Now, the phrase compensation in respect of the grant is not particularly helpful, but case law has indicated that the general compulsory purchase principle of financial equivalence will apply in these cases, and also that injurious affection may be claimed. So injurious affection is the depreciation in the value of land as a result of the electric lines being there. Again, moving on to the next slides. So in cases where compulsory powers are used, landowners should consider very carefully whether or not an objection should be made. Fair to say it is seldom the case that opposition will result in a CPO or an application for a necessary way leave being refused, and considerable expense will be incurred in maintaining an objection all the way through the process to a determination. There may, however, be good tactical reasons for making an objection, whether that's to secure a fairly minor but important route alteration, mitigations, or other benefits, for example, accommodation works. In each case, it will depend upon the particular circumstances and a weighing up of the potential gains as against the costs and the risks involved. As for negotiating more favourable terms in any consensual agreement, and indeed most cases do proceed consensually, there are a number of areas in particular where adverse impacts can be minimised. Perhaps the most important here is agreeing the location of the apparatus and the extent of any way leave corridor. It's important to clearly identify the agreed route and the relevant way leave or servitude plan, and ensure that within the documentation the rights are limited so far as possible to that defined route. As the compensation will be based on this, provision should be made for additional compensation to be paid in the event that contractors cause damage out with agreed working areas, and that's a fairly common occurrence, or in the event that the construction period is extended beyond that originally contemplated. So, if it's a 12-month construction period anticipated, but it runs on for 18 to 24 months, then additional compensation should be due in those circumstances. The duration of any agreement should also be considered. It's an important factor. The electricity companies will typically insist on a perpetual servitude if injurious affection compensation has been paid out. And in most cases, landowners will be willing to grant a servitude given the more or less permanent nature of the infrastructure and the statutory protection it has. However, it's certainly not a case of one size fits all, and there may be very good reasons to opt for a way leave that can be terminated on notice if, for example, a landowner wishes to preserve the ability to claim compensation in the future, for example, for loss of development value, if the development plans are not sufficiently advanced at the time that the negotiations are ongoing with the electricity company. Finally, in relation to the consideration and compensation package, the starting point will be the payments that a landowner can expect to receive if the rights are acquired compulsorily. However, it's often the case that higher payments can be secured through negotiation to avoid the additional time and costs involved if the electricity company has to proceed under its statutory powers. That brings me to the end of my section, and I will now hand over to Graham.
Good afternoon. I'm Graham Leith, partner at Brodie's, and today I will be speaking about natural capital. I will look at how natural capital sector is operating in Scotland at the moment, opportunities for landowners in this sector, and the current challenges and barriers to participation. The term natural capital is quite wide-ranging, and it can often be used interchangeably to mean different concepts in the supply chain. But what I would like to focus on was the monetising of natural capital activity in Scotland, and particularly from a landowner perspective. Currently, that means carbon sequestration, and specifically under the Woodland Carbon Code and the Peatland Code. These codes are the quality assurance standards for woodland creation and peatland restoration in the UK. And under the Woodland Code, the party carrying out the project must evidence that the trees planted have sequestered carbon dioxide from the atmosphere, or in the case of peatland, that they have reduced the amount of carbon dioxide that would otherwise have been generated by the peatland degradation. And a carbon unit will be issued in respect of every tonne of carbon dioxide, and those units can ultimately be reported by corporates as part of their UK carbon reporting and their net zero efforts. There's huge market interest in natural capital, from corporates with net zero obligations and fund managers looking to satisfy the increasing appetite within the investor community for natural capital assets. As many of you will be aware, the codes contain rules designed to ensure that the carbon sequestration can be robustly evidenced, and also that the units are not generated from activity that would have been happening anyway, and that they would have been financially viable without carbon income. This is what is known as the additionality test. At the moment, activity is all under the Woodland Carbon Code and the Peatland Code. However, there are a number of other carbon sequestration codes in various stages of development, as well as codes that will help promote other nature benefits, including biodiversity. These include the Soil Carbon Code, Seagrass Code, and the Biodiversity Enhancement Add-on to the Peatland Code. And we expect all of these and others to be brought forward over the next few years. So moving on to the next slide, and looking at the existing codes, a landowner that has suitable land has a range of options, and the decision on which structure to adopt will be influenced by multiple factors, including the landowner's financial position and also their attitude to risk. If a landowner is in a position to do so, and they consider that the value of carbon units will continue to rise, then they may elect to just retain the full benefit. There will usually be grant funding available to cover some of the establishment costs, and with a good project manager and the right site, a landowner could see their project develop into a very valuable asset. When the carbon is sequestered at each vintage, then verified units will be generated, and the landowner is then free to sell any or all of these to the highest bidder, or they can retain them as an investment in the hope that prices will rise. Or if they wish to do so and require that, then they can utilise them as part of their own carbon reporting or under their supplier agreements. These verified units are protected by the buffer, so the landowner generally has no ongoing liability to buyers if there is a loss event after the units have been verified and sold. And if the land is ever sold in future, then it can be sold with the benefit of future carbon income, which should enhance any land value. A hybrid option might involve a forward purchase agreement or an offtake agreement, as it's sometimes called. There are a spectrum of possible structures within this general ambit, but at its most basic, this is a contract that obliges a landowner to sell all or an agreed number of verified units to a particular buyer at each vintage. The unit prices can be agreed at the outset, perhaps with some form of price indexation, or a price variation based on vintages, or an agreement that the units will be acquired at the market value, as and when they're verified. The benefit to investors of such a structure is that it provides them with a reliable source of carbon units, whilst the landowner can rely on the income. It would also be common for such an arrangement to involve some early seed money to help the landowner with establishment costs. And as with the first option, if it's structured in a particular way, then the land value can be enhanced and the landowner risk minimised. At the other end of the spectrum, there is the option where a single investor acquires all of the pendant issuance units, or PIUs, in a project at its outset. Such a buyer can expect to pay a significant sum up front to cover all the costs that are not grant funded, and usually an additional premium for the landowner as an incentive to enter into the contract and take the project forward. Some of the payment may be linked to verification of units. Common features of such contracts are standard securities to protect the investment and stringent obligations on the landowner to ensure the project delivers at the anticipated levels of carbon sequestration. This will result in the project carrying significant liabilities but limited future income opportunity for the landowner. It can restrict land value and the marketability for future sales, and it potentially passes liabilities down the generations. Some of these contracts can last for 60, 80 years or even longer. However, the risks can be mitigated and the returns may justify this approach. But as with all carbon sale contracts, it is important that entrants go into any arrangements with their eyes wide open and having taken sound professional advice. Whatever structure is adopted, this sector continues to grow and rural land is essential to its success and the delivery of the projects, so the role of landowners and managers cannot be underestimated. As those who are involved in the sector will know, the delivery of projects is not keeping pace with the market interest. Just moving on to the next slide, please. And it is recognised that increasing scale is going to be essential to not only the perceived success of the codes, but also to investor and landowner confidence. I would now like to look at some of the obstacles that the sector is facing and how these obstacles may be overcome. Landowners who wish to participate in the sector will not be able to avoid risk altogether. Even if they are able to avoid liability to investors by retaining the interest in the project until the carbon is sequestered, no nature project is certain to succeed in the way that parties initially envisage. Experienced project managers are essential, but even with the best possible implementation, factors including climate and environmental changes, supply chain and labour issues can all impact on the success of the project or the timescales for sequestration. And the cost of all of the administrative and compliance requirements of the code also need to be covered, with no guarantees as to the levels of financial return. When negotiating sale contracts, we often see evidence of a disconnect between the investor expectations, and in particular the need for certainty around availability and pricing for their carbon reporting requirements, and the realities of delivering projects that are very dependent on site-specific and landowner-specific factors. Brodie's is one of 3 Scottish legal firms who are working with Scottish Forestry to develop standard form purchase and sale contracts with funding from the Ferns Initiative. Peer-reviewed contracts that have the support of the code administrators and come with detailed explanatory guidance should provide assurance and support participation. Whilst there is never going to be a one-size-fits-all solution for carbon projects, we're confident that this process will help inform and educate all parties and hopefully facilitate increased participation. The costs of administration and compliance is also a potential barrier and is preventing participation by certain landowners who are otherwise enthusiastic and have suitable land available, but are faced with the prospect of professional fees and administrative costs that are out of kilter with the potential return. We're aware of various initiatives where clusters of landowners are looking to team up in order to share costs and put in a project together that can then make a viable return. That is not free of complexity though, although it's certainly a step in the right direction. None of this is intended to suggest that any of the challenges I've mentioned facing the sector are insurmountable. There's a huge political will to see this succeed, and a lot of work and time being invested on the landowner and investor side to develop contract structures and funding models that balance interests of landowners and investors. It's an ongoing process, and we see the next couple of years as key to the future direction and success of the existing codes, as well as natural capital in general. And I'm now going to pass over to my colleague Lee.
Thank you, Graham. So I am Lee Gould and I advise clients on tax and succession issues. I first gave this presentation in person at the Instant House Hotel in Inverurie last month. But 2 weeks later, we then had the budget on the 30th of October. And that budget has brought in the biggest change to inheritance tax, which I've seen in my 25 years in the profession. I've therefore taken the opportunity to rewrite this presentation so that I can focus more on the budget and the impact that has on farm businesses and the opportunities for planning here. So the three key takeaways for me today are: one, inheritance tax reliefs are still available for farm businesses, but they have been reduced. The new added IHT bill on farms creates a cash flow issue when the owner dies. Two, the tax bill can be minimised or managed by will planning and/or lifetime planning. And three, that planning to reduce the tax bill does require a decision to be made on who the heir to the farm is going to be. So what I'll do first of all is look at the inheritance tax and then look at choosing your heir. So to go on to the next slide and the autumn budget. So the first thing I want to do is take a brief step back and look at inheritance tax, what it is and how it works. So inheritance tax is a tax levied on death, on the value of what you own when you die. It is also charged on any gifts made by you in the 7 years before you die. And the tax rate is 40%. Farm businesses can qualify for reliefs from inheritance tax. And before the budget, that could bring your tax bill down to zero. That meant you could keep your farm, keep it in your ownership during your lifetime, and when you died, it could pass to your heirs with no inheritance tax payable. That meant farm businesses didn't have to take on debt or be broken up and sold off in order to pay the tax on a death. So there are two reliefs for farm businesses. The first is agricultural property relief, and that's available for your agricultural or your farming activities. If you've diversified away from farming, for example, into wind turbines, that's not farming, so this agricultural property relief disappears, but there is an alternative business property relief, which applies if you have an overall trading business. So not rented out land to other people to do business, but you doing other things in a business, which is not farming. And the natural capital, which Graham has just spoken about, that is not seen as agricultural activities, so the APR relief doesn't apply, but it can qualify for business property relief as part of the business. So generally, pre-budget, pre the 30th of October, you could get a 0% inheritance tax rate on your farm on death and therefore leave it to your heirs tax-free, burden-free. So what did the budget do on the 30th of October? Well, it hasn't removed APR or BPR. Those two reliefs still exist. The budget didn't change the rules for when the reliefs don't apply. The reliefs are still available for farm businesses, but what the budget did is it halved the amount of the reliefs, but introduced a new threshold. And this is coming in from April 2026. So what the Chancellor said on budget day is that if you qualify for APR or BPR, then the first £1 million of those assets will be free of IHT on your death, but the rest will be taxed with a 50% relief. So the easier way to explain it is you won't be paying IHT 40%, but you won't be paying it at zero either. You'll get the first £1 million tax-free and the rest will be taxed effectively at 20%. So to take a simple example, with a family farm worth £3 million and ignoring any other reliefs from inheritance tax, before the budget day, that could pass on death with a zero tax bill. Now, the first £1 million will be relieved from tax, but the £2 million of your £3 million value over and above that will be taxed at 20%. So your £3 million farm will have a tax bill of £400,000. That is a serious cash flow issue for farms. This is a tax charged on death. A death is not usually something a family can predict, and it comes at a time which is already very difficult. The inheritance tax has to start to be paid from 6 months after the death, which is a very tight timescale. There is an option to pay inheritance tax over 10 years in equal annual instalments beginning 6 months after the death. But if in our earlier example, you have a £400,000 tax bill over 10 years, that is still £40,000 per annum, which has to be found from the farm to meet that tax. So how are people going to fund this? You could look at any existing life insurance and whether that could be repurposed to pay the tax. You could get advice about new life insurance to cover it. You could look at other funding sources or building up some sort of fighting fund to pay that tax. But clearly that all costs money. So that makes it really important to do whatever you can to minimise the tax bill. So in terms of minimising this new tax bill, importantly, the budget didn't remove some of the opportunities for tax planning here. So we still have the spouse exemption. What this means is if you leave the farm to your spouse, then because you are married, you get a spouse exemption from inheritance tax. So there will be no inheritance tax to pay at that point. But this is only a deferral. So if you die owning a £2 million farm and leave that to your spouse, you pay no IHT at that stage because of the spouse exemption, but your spouse then dies with the £2 million farm and will be paying this 20% tax above the £1 million allowance, so £200,000. There is a devil in the detail with the new rules because the £1 million tax-free allowance you get against your farm is not transferable between spouses. So each of you and your spouse have £1 million of allowance, but if spouse one leaves the farm to spouse two, they've wasted their exemption because the spouse exemption already applies and you can't have both. And then when the second spouse dies, they've inherited a £2 million farm, but they only have the £1 million allowance. So the planning opportunity here is that you make sure each spouse has at least £1 million of value, and in their wills, they don't leave it to their spouse, they leave it to the next generation, the ultimate heir to the farm, and therefore you can double up the allowance and get your £2 million farm down to a zero tax rate again. What the budget didn't do was remove the other tax planning opportunity, which is making gifts of the farm during your lifetime. If you give the farm away in your lifetime, so long as you give up the benefit of what you've given away and you survive 7 years, then that is removed from inheritance tax and you will effectively be paying a zero rate again. But with lifetime gifting, you have to consider affordability. Can you really afford to give that asset away? Because we have this £1 million allowance on death, it might be you can retain £1 million of assets and only give the rest away if that does anything to help affordability. The other concern with lifetime gifting is asset protection. So if you give all or part of your farm to the next generation in your lifetime, what if that heir gets into financial difficulty, for example, through a divorce? Could that mean that potentially a claim is made on the farm? So there are things we can do to protect that asset. The other thing the budget did not change was the capital gains tax reliefs, which apply to farm businesses. So if you make a lifetime gift of your farm to save inheritance tax later, then there can be an immediate capital gains tax bill on that gift, charged on the difference between the farm value when you acquired it and the value when you give it away, which can actually be quite large, particularly if you've perhaps had the farm for a long time. But there are capital gains tax reliefs generally for a gift of farming businesses, so that does help. So the changes don't come in until April 2026, so there is a bit of time to plan. And I think people at this stage should be thinking about three things. The first thing they should be doing is revisiting their will, at least looking at changing wills to make sure that each spouse is using up their £1 million allowance so that you're getting £2 million allowance between you. The second thing to think about is lifetime gifting. If you can afford to do that, to remove value from this tax net and accelerate the succession to your farm. And the third thing to think about is whether you actually just combine the two. So give away enough to leave yourself and your spouse with £1 million each and rewrite your wills to double the allowance. So it's all very well for me to talk about changing your will to leave the farm to the next generation instead of your spouse, or to think about lifetime gifting to the next generation. But we then come on to the secondary, very difficult question of who is the next generation, and who do you want to will or gift the farm to? And what we often see with people with farms is that if you have, for example, 2 children and 1 farm, 1 business, you might not want to split that business on your death between the 2 children, because you might then be left with 2 smaller farms, and that may lose economies of scale and just mean the farm's not able to survive, particularly if we have this IHT bill added on the top as an extra burden. So some people will take the view that actually it's better to keep the farm intact and leave it to one child and not the other. Most disputes over wills after death happen because people are surprised by the contents of the will. So it is worth, if you can, having a chat around the farm table with your family. And if your decision is that you would prefer to leave the farm to one child and not the other, if you can discuss your reasoning behind that and remove that element of surprise, then that is all the better. So how do you deal with this? You have 1 farm and 2 children. Well, you could leave the farm to one child and put aside other assets for the second child. For example, if you had assets outside of the farm, such as life insurance or pension, could that go to your other non-heir child? Do remember, if you're going to leave the whole farm to one child and not the other, then your other child does have a legal rights claim to part of the value of your estate. Now, that legal rights claim doesn't extend to land and buildings, which is where most of your farm value is. But if your farm is owned by the partnership or a company entity, then it does form part of the other child's claim. So there's quite a lot of planning we can do around that if that is a concern. If it is going to be a concern that second child might dispute you leaving the whole farm to the first child, what you could think about doing is lifetime gifting to your intended heir during your life, so that when you die, there actually is nothing or there's less for your other disappointed child to claim. For some families, the thought is actually both children should be heirs to this farm, that is the fair thing to do. So how on earth do you do that? I actually think this new £1 million allowance for relief against APR and BPR to avoid the 20% charge means it's more attractive to be sharing the farm out among more than one child. Because if you think, when they then pass on to their next generation, they have a £1 million allowance each. So the more children holding that allowance, the more chance that farm has to roll on to the next generation again without a tax charge. So how do you leave one farm to 2 children? Well, some will leave the farming activities to one, but the diversified activities, for example, the holiday lets, to the other, so that the things that are not the actual farming. You could leave or gift your asset to both children and just simply leave them to run it together and sort it out between them, but that doesn't work in all families. So if that's not going to work, if they're not going to work together, what you could do is leave the farm to one child, but put a provision in your will about the option for some sort of buyout, so that the child who wants to carry on the farm can do so, but has to provide some cash to the other child who is going to otherwise lose out. So I'll just go back to the key takeaways slide again. So the next slide, I think, repeats the takeaways from today. Thank you. So you do still qualify for IHT reliefs if you meet all the rules. There are still IHT reliefs for farm businesses, but they have been reduced. So for a lot of clients, that will have added an IHT bill, which they didn't have before, which creates a serious cash flow issue when the owner dies. So planning to minimise that is really key. And that's going to involve will planning and/or lifetime planning to minimise that tax bill. But all of that planning requires a decision to be made on who the heir to the farm is going to be, which might just well be the hardest part of the planning. So lots to think about, lots to discuss with people. So happy to take questions on that. So I'm now going to hand back to my partner, Clive Phillips, who's going to look at questions and answers. Thank you.
Thank you very much to all our speakers. So we're now going to move into the Q&A session. We've got a few questions here. So we've got one here, I think, for you, Alex, on land reform, and it's a question about resumption. And essentially, the question is, can both parties, landlord and tenant, agree to a shorter period, say 2 months, by agreement between them? Is the bill clear on that at the moment?
The bill at present sets out the process for resumption using the word must. So the landlord must serve notice, and it must be on the basis of the period of 1 year. I think probably the answer to this is that, as always, parties are free to make their own agreements and to contract as they want. Within the strictures of the bill as drafted, I don't think you could say that it was a 2-month resumption period, because I think it must be 1 year's notice. However, that said, as currently happens in a lot of circumstances, the possibility of resumption is discussed with a tenant, and that is available to the landlord and will still be available to the landlord, albeit on a longer notice period. But what then happens is you have, if you like, resumption by agreement, which is in effect a renunciation or a partial renunciation of the area of ground that would be susceptible to the resumption. So I think the answer to that is that it would be a matter of free negotiation against the backdrop of the statutory provisions. That said, I suppose that the landlord is potentially going to be in a slightly more compromised position, where he's looking at a year's notice rather than 2 months' notice, in terms of trying to just agree a partial renunciation.
Great. Thank you very much. Scott, we've got a question for you here about injurious affection. And the question is, does injurious affection claims apply even when a necessary way leave has been obtained?
Hey, so short answer, yes. Injurious affection compensation can be claimed when a necessary way leave has been granted. The reason for that is that necessary way leaves are granted for a very long time. The default period is 40 years. It is open to the power company to seek a longer period than that, and they often do. Equally, an owner can seek a shorter period, but would have to be able to justify a reason for that. So it's more or less permanent once a necessary way leave has been granted, because it binds successors in title. So that can have a depreciating effect on the value of the land. And it can be in two different respects with electric lines. First of all, you've got the way leave corridor, which is effectively sterilised by the power line. So the way leave will prevent, for example, building underneath the electric lines due to health and safety reasons, or in the case of cables, underground cables, building on top of them. And high voltage lines, the kind of way leave corridor is typically 80 meters or even up to 100 meters. So we can be talking about a very sizable strip of land that is sterilised, that cannot be developed in the future. So compensation is available for that. Mm-hmm. But it can also apply to the wider land holding. So if the value of the wider land holding is devalued because of the presence of the electric lines, and An example there would be if you've got residential properties in close proximity to a line, then they would quite typically depreciate in value because people that are living in houses next to pylons, that's going to impact on the value of the land.
Great. Thank you very much, Scott. So, not surprisingly, a few questions coming in for you, Lee, following the budget. So, I'll give you the first one actually.
Okay.
It is question really is about the interaction of the sort of £1 million with other reliefs, which is nil rate band and the 175k residential nil rate band they've put here. So it's whether or not those are still available.
Yes, they are. So the nil rate band of £325,000 is still available on top of any APR or BPR. There is also, in addition, the £175,000 residential nil rate band on top of APR or BPR, where the conditions for that are met, which is all very helpful. But two things to flag. Your 325k nil rate band will also, from April 2027, include proportionately part of your pension. Your pension's going to be dragged into the IHT net, so we'll be using up some of that 325k where it didn't before. The residential nil rate band is highly complicated and technical. And if you have your farmhouse actually not owned by you, but owned by a partnership or a company, I think there can be an argument that actually that's not what's in your estate. It's not a residence. It's an interest in an entity which owns a residence. So, and the other real nasty on the residential nil rate band is it does not apply if you and your spouse own assets worth over £2 million. So for most people with farm businesses, they'll have £2 million of assets between them in the farm, and therefore your residential nil rate band goes away straight away. So we often don't see that available at all. So yes, you do still get these other allowances, but there's a bit of devil in the detail on those as well.
So in a sort of similar vein, actually, Lee, and just take this one at the same time, it's a question I think that's probably on everyone's lips, are there opportunities to use trust to hold land or businesses separately in companies in order to multiply up the benefits and perhaps take advantage of a sort of more periodic type charge? I know that's a big question, but perhaps just a couple of comments on that.
I'd actually like to do a separate webinar just on trusts at some point once we've seen the finance bill. So we don't know at this stage how trusts are going to be affected because they're waiting for a consultation and the finance bill wording to come out of that. But generally, holding assets in a trust does mean that you have a tax charge every 10 years of 6%, which arguably might be 3% once you get your APR and BPR against it. And that's a 6% charge every 10 years rather than a 40% charge when someone dies. So if you can get assets into a trust without triggering tax at the time, they can be very beneficial and also good for protecting assets down the generations from divorce, separation, doing the wrong thing. But I would hold off on any trust planning until the consultation in the new year, until we get an idea of what actually is intended. There's a question there about holding in companies as well. Some families do use companies. It can be a lot more flexible in terms of giving away parts to the next generation. It can be easier to transfer shares than bits of land or partnership interests. The thing to flag with companies is this legal rights, the rights a child has to go against your will and make a claim. That doesn't extend to land and buildings, but it does if they're in a company, and there's limited planning you can do with that. There's more planning you can do with a partnership. So there are things to weigh up with companies and also with trusts, but generally are both vehicles used for farm businesses.
Okay, thank you very much. Graham, a question's come up for you in relation to natural capital. You obviously flagged lots of opportunities there in that sector, which is growing rapidly. But you also mentioned some barriers to participation in the sector. What do you think the main barriers are at the moment, which is standing in the way of it moving forward?
I would say probably the principal one at the moment is the costs of projects, and I think that's perhaps just a reflection of the fact that we're quite early in the whole carbon sequestration process in the UK. There's lots of different approaches to the contracts and to just taking the projects forward as well, and different views as to how that should be done. And I think as a consequence, there's a lot of um, professional fees and costs that are involved in any project, and particularly when you're talking about smaller projects, I think that's got uh, more of an impact. They don't have these um, economies of scale, and I think also there can be a view in some quarters that there's quite high profit margins in these types of projects from landowners, and that I don't think is reflected in the evidence that we're seeing at the moment. You know, if carbon prices increase as many expect them to, then we might get to that place. But I think, compared to perhaps renewable energy projects, which are much more mature and more potential for creating energy and returns to the landowners. I think we're a long way from there as far as carbon sequestration is concerned. So yeah, that I see that as quite a barrier to, certainly for smaller sites, being able to participate.
Mm-hmm. Okay, thanks, Graham. Okay, I'm going to take one last question, then we'll wrap it up. It's a question really, I'm not going to take it quite as it is. It's asking about, is there potential for future carbon tax, land tax, and also potential environmental property relief instead of APR or BPR. But Lee, I don't know if you would like to comment. I mean, there are some relief still available under APR, I think, for land used in environmental schemes. Is that right?
Yeah, so there was a bit of this in the budget. Certain environmental schemes are now within scope for this, for release from inheritance tax. That was specifically announced. And just generally, if you're involved in an environmental scheme and it's not specifically named as qualifying for relief, you can still get general business property relief for participating in those schemes. Business property relief can be a bit tricky though, because you have to look at what you're doing, and if you're a landlord letting land for someone else to do something, that doesn't get it. But if you're taking part in a business venture, it does. So just need to be a bit careful. But yes, generally BPR will
Yeah.
apply.
Good, thank you. It's probably a space to watch, isn't it? Development of
Yes.
tax in this area, because just as the sector develops, we don't really yet know what it's going to do to land values. Is it going to increase land values, or might it actually go the opposite way? And if you have a site that is burdened with an obligation under a carbon or natural capital scheme, might it even reduce values? So what's all that going to look like? It's bound to develop. Okay, well, look, I mean, it'd be great to carry on chatting and take the more questions, but I really should draw the session to a close. I hope it's been useful, and thank you everyone for your questions. Undoubtedly, a lot going on in land reform. There's a lot that's unresolved there. It's still in the stage of a bill, so there is opportunity for us as landowners, farmers, estate owners, or as advisors and consultants to participate in that process and try and influence the outcome of the bill. And it's also, I think, very useful to hear from Lee so quickly after the budget. And clearly, there are opportunities. There is a window to do some planning now before all of this comes into force in April 26.
Yeah.
So good reason for people to dig out wills, dig out succession plans, have a look at values, and take advice before they do anything. We don't yet know what all the rules are going to be, but we can start to form a view so that there is then time to act before it comes into place. So just before we sign off, I'd like to mention that we do produce a monthly e-bulletin on rural business and natural capital. It also features guest pieces from tax, succession, and other parts of the business. We've also produced a suite of insight notes on the budget, individual ones covering estates, farms, forestry, businesses, and pensions. So if anyone is interested in any of those, please get in touch with your usual Brodie's contact or get in touch with me and we'll make sure that you go on the list and you receive those publications. Okay, thank you very much. Wish you all the best for the rest of your day.